We're here to talk all things gold and silver with Todd Bubba Horwitz of BubbaTrading.com. Todd, you are well followed on our channel. Welcome back.
David, it's always great to be with you and love to talk about gold and silver.
I'm looking forward to catching up, Todd. It's been a while. I want to talk about your trades first. How are you positioned first and foremost for gold and silver?
Okay, well, right now I am positioned short both gold and silver from a trading standpoint, but I want to make it clear to everybody that I'm always long physical, and I don't sell the physical. As a trader, I am trading gold and silver to the short side, and I think that they're going to turn out to be pretty good trades. We've been short from much higher, and it looks to me they're going to try to break out the bottom end here now. Now, we did have a little bit of a bounce back, but it's looking, gold especially is looking very weak. Silver is kind of steady at the moment.
What do you mean when you're not trading physical? So what do you trade? What instruments do you use?
I trade the futures, okay? I trade the futures of the COMEX, okay, as a trading mechanism. But I'm always a buyer of gold, silver, and platinum, as an investor. I don't trade my investments. I think that's an important point for people to understand, is investing is one way to get involved, and you're going to hold those positions, and trading is another. I don't think investors should be trying to time out the market. I think that investors should be watching the market. And again, if you're investing money that you can afford, then there's no reason to try to flip it or trade physical metals. I think it's too expensive, and I think it's too risky. And I think, again, you want to trade, you use the board, you use the futures, you use any of the variables of gold. But if you want to invest, you buy the physical.
True. So you don't ever sell your physical?
Never. My kids will sell when I drop.
Lucky kids, hey? Now, Todd, I want to talk about the real interest rates. They're still negative. One argument I heard was that gold should be a lot higher right now because real interest rates are still in negative territory, yet we haven't seen a breakout to, above $1,800 for a while. Why is that? Why do you think that is?
Well, I mean, you can make a case for anything you want. And if you have an opinion, you can formulate your opinion to what you want the market to do. However, I don't have any opinion, other than a long term that I think gold will be higher. But in the short term, the price action is extremely negative, and these markets, the gold's got a chance to really break hard down. Now, again, I don't predict. I am short, and I'm positioned correctly for the moment. But if we break below 1,700, I think 1,600 is next, and I think it gets there quickly. You can't tell the market what to do. The market is always right. It's absolute. So even if you think that because interest rates may be negative, even though they're, the 10 years, 1.5, it doesn't matter, because at the end of the day, they mark your position based on the price that it closes at. And that's price action. And if you don't use price action, you're really creating a much bigger problem for yourself.
It's a good point on the downside, Todd, but what about the upside? We're close to $1,800 now. 1770 is the latest price on my screen. What if we hit 1,800? Is that the breakout point for us?
It could be. Look, I think that gold's got a lot of work to do to turn the overall negative trend that it's in at the moment. Now, again, 1,800 could be a start. It really depends on how it gets there. If it would go to 1,800 tomorrow, I would say that'd be very negative, and I would want to be a seller there. If it gradually starts to climb and reverses trend, and the price action shows that not that there's a big gap when they caught everybody short, but that the buyers are starting to take over, and you start to see steady growth or steady improvement in price, that's a lot more effective than a spike move. A spike move, again, if we hit 1,800 tomorrow, I will guarantee you I will be selling extra for a trade, because I would consider that as a blow off, and more than likely, traders got caught short and they're trying to cover.
Yeah. What do you think about the yields this week? Falling treasury yields hit the headlines for the gold market. Do you think yields will continue to fall?
Well, it's hard to say. We have a Federal Reserve that is that has no idea of where they are. I think they're using a model that's probably 100 years old. Okay, and they refuse to adjust. They're finally admitting to inflation. They switched from transitory to temporary. Now, we know it's not temporary, because once manufacturers or retailers raise prices, they're not bringing them down. This is not a gas station. So I think that the bond traders are waiting for their moment, the fixed income traders, because that is the biggest market in the world by 10 times at least. And I think they're going to make another step to force the Fed to taper okay, and get these rates higher. In the meantime, they have been drifting lower, and we've been just slightly below in the 10-year, which is the key benchmark, below 1.5%.
Mm-hmm. And what about silver? How do you feel about silver right now?
Well, I mean, I'm negative silver right here too, but again, I'm not a big fan of being short silver versus being short gold. I think that silver has been in a very tight range. When you go back last year, we had about an $18 range. In the last, I think, 12 months, I think we had a $6 range. So it's really a very tight range, which indicates there's a much bigger move on the horizon. And right now we're short. Now, I wouldn't be surprised if it broke to the upside, and the chart and the pattern and the price action is significantly better than the gold is right now. But again, that can change in a hurry, as we've seen in the past. And I think the same thing goes for here. As an investor, I think silver is a great buy. In fact, I think if you label them in order, I think it's platinum, silver, and then gold for now. But overall, silver, I think, is much steadier at this point. It's really dead in the middle of its range. And I think it's got a greater likelihood, if it's going to reverse, that silver would reverse first.
Okay. ADP National Economic Data came out today. 692,000 private sector jobs were added. That's much higher than the 550,000 jobs that were expected. So what's your reading on this, Todd? Do you think this is a sign of higher inflation to come?
Well, I don't know. I think we're trading at a real inflation of over 10% anyways, okay? I think that the jobs...
Hey, where's that coming from, Todd? Back up here.
Look at prices. Look at the price of oil. They when they come out with the CPI and they tell you excluding energy, well, again, at the end of the day, energy may, at the pump, it may not be part of your inflation curve because it goes up and down, but it affects every business that you're in. So inflation is ridiculous right now. Look at the price of copper, copper, and look at the price of oil. I mean, oil is over doubled since the election. Copper is threatening to make high highs here now. I mean, it's been down the last few days, but again, you look at all of the commodity spaces, and they're booming higher, which means higher price to the consumer. And I think that we're seeing it, and I think we're feeling it. Okay, so I think when you look at inflation, it is real, and the Fed refuses to admit to the fact because, of course, we've got too much stimulus going on. We've got too much adding to the money supply. And you got too many people saying, no, I'm lazy. So the jobs number, to me, is natural here because we didn't work basically, in certain places for the last 12 months. So you're putting people back to work. So to see a rise, these kind of numbers is not unusual. Let's see if these numbers a year from now are going to measure up. And I would say they will not.
What do you think is going to happen on Friday when the non-farm payrolls is going to be released on Friday? First Friday of every month, June's reading. Do you think it's going to be hotter than consensus?
It's hard. It's always hard to say. They're always adjusting. The real problem with these numbers is they're not firm numbers. Anytime you get a government number, it's ridiculous because they're not necessarily real, and they will always adjust. So should it be hotter? I mean, based on ADP, it would be hotter, but again, they don't always work in sync together, and it's hard to grasp where they're going to be. Based on the jobless claims of recent vintage, I would suspect the number will be hotter than we think. But I don't know what kind of reaction we get from the street because we're seeing a continuation of a dramatic rally in equities, which, look, at the end of the day, we keep making new highs. So, to me, the markets are very comfortable, but of course, a lot of that's got to do with the cheap money.
Based on people we've talked to and reports we followed, there still is a labor shortage here in the United States. Now, some people say that this labor shortage problem could be fixed once the enhanced employment benefits end in September and people stop getting paid their stimulus checks from the government. What do you think is going to happen?
Well, I certainly hope that happens. I got news for you. I'm really tired of this ridiculous stimulus, and I'm tired of people saying they make more money staying at home. Of course, those are not people you'd want to hire to your company anyways because they're lazy to begin with. But at the end of the day, we've already had 26 states stop the benefits, okay? And I think there's going to be more before it ends because you do have that problem. There is help wanted everywhere. And now, the employees are in control, okay, which is fine. Okay, listen, if salaries are like a price discovery market anyways. You need help and you want to pay more, you'll pay more. You'll pay what you need to get your help. So at the end of the day, I think that, that hopefully the stimulus will end because it's causing a lot of havoc in the rest of the economy.
Well, maybe people aren't lazy. Maybe they just got laid off and they're looking for another job. This is an
Well,
interesting.
I'm talking about the people that could get jobs. There's plenty of jobs out there. And I'm
Sure.
not talking about someone who's a tradesperson or whatever. I'm talking about people that work for the lower wages and that don't, that they get, if they would work, they would make 1,400. If they stay home, they get 1,500. That to me is a backwards model, which shows you, in my opinion, the ignorance of government for continuing to feed this stimulus when we need these people to go back to work. And I think what's going to happen is these workers are going to get replaced by illegals like it used to be. And then when they need jobs and there is no more stimulus, then where are they going to go?
Yeah. This is an interesting statistic. I was looking at charts from research reports. The quit rate is up. So the number of people quitting their jobs is up. I wonder why that is. Do you have any theories as to why that might have happened?
Oh, yeah, well, that's an easy one. Look, there's a lot of companies that need help and they're willing to pay more. So if you can improve your salary or improve your hourly wage by quitting and going somewhere else, why wouldn't you? You know, the employment field has become very competitive, opposite of the 2008-9 when we were overemployed. Now we're underemployed. So employers are willing to step up and pay more. I saw a sign yesterday that a place was willing to offer a $500 signing bonus if you came to work for them. So you can see the demand for help is way up, okay, and people can get better wages than they could ever get through real minimum wage because companies are paying more than a minimum wage because they need to get help, they need bodies to work, and they need people to fulfill.
See, this is why I like talking to you, Todd, because you're both a trader and an investor. So let's take a step back and look at the bigger landscape here as an investor. Take a step back outside of gold and silver. What are the biggest economic problems that an investor needs to address right now? We've talked about a few of them already, but what else?
Well, I think obviously we did talk about inflation, and I think you've got a market that is extremely overrun and overpriced. Now, again, it can go for longer. There's no timing in when the markets themselves are going to sell off. But I think what you're really seeing here, David, is the capitalist versus the socialist environment. And of course, the extremely uber wealthy don't mind the socialism environment because they can continue to capitalize either way because they got the money. And I don't think you've seen the average investor, although their 401k has gone up, and we can argue whether it's up because the money supply keeps getting added or if it's real gains. But I think we're setting up for a very nasty correction at some point, and I wouldn't be surprised to see that correction as big or bigger than 2008-9. It's natural to the market, and the way that they have fed and artificially pushed this market up, to me, could create a much bigger problem down the road. But in the meantime, we're still long, and I'm not doing anything until it changes.
But okay, Todd, the counter argument is that from market bulls that I've heard is that it's unlikely to get a correction before the Federal Reserve raises interest rates, which they're not going to do anytime soon. I've been hearing doubters. People are doubting the fact that we're going to get 2 interest rates next year, even though that's what they've telegraphed. But people say, that's not going to happen. What do you think?
Well, look at it. We all are entitled to our opinion. They're all wrong, including mine. I think the price action will tell you what the market's going to do. And we know one thing for sure. A bell doesn't get rung when the bottom or the top of the market is put in. And when the market decides it's ready to go down, and there are a lot of signs now that are sending warnings, but we don't pay attention because, of course, we get very complacent when the markets are going our way, and we forget the basics of being protected just in case. Now, again, I'm not predicting anything. I don't know when the markets go down. I will guarantee it goes down, and I would bet, that it would go down before they make 2 rate hikes. I think we're going to watch.
Okay.
If the bond traders push and they can get the 10-year over 2%, I think you'd see an immediate meltdown there because there are too many people in the markets right now that would prefer to be in fixed income and not in equities.
So let me just summarize this for you, Todd. We're going to get 2. We're unlikely to get 2 rate hikes anytime soon, and possibly we're going to get a correction before 2 rate hikes. And if we do,
I think both of those are true. But I do think that there's a better chance also that we get rate hikes faster. Basically, the Federal Reserve is way out of their box of what they're supposed to be doing. Yes, it's supposed to be full employment, but they're going to create either hyperinflation or stagflation here, very much like the Jimmy Carter era. Okay. Right. And I think what will happen is that we will start to see reasons for selling, and pressure will start to get, there's a lot of weak hands that are holding equities. So, when you look at it, okay, and you understand it like that, again, I'm not predicting it's today or tomorrow, but, the rate hikes will come. And I think what will happen is the Fed is testing, and they went from transitory inflation to temporary. The next step is real inflation, right, and we'll see how the markets react and how they react. But certainly the demand for money is huge. Just look at the housing markets, and they certainly could go, rates should be higher just on natural price discovery, which is suppressed by the government and the Federal Reserve.
So the next correction should be greater than the one from 2008. Of course, nobody knows when it's going to happen, but if it does hit us, it's going to be pretty monumental, is what you're saying.
It's going to be nasty. Because
so what do we do then? What do we do? I mean, as an investor, do we go to the bond market? You told me you're short gold and silver. Equities, weak hands in equities, like you said. Where do we go?
Well, I mean, you can either use derivatives to hedge your overall portfolio. One thing I can tell you for sure, David, is I do teach a hedging program, but if you just stay in the market, okay, again, you can't time the market. It's time in the market. And if you just stay in and do nothing, the market has still proven in its history to go up 8 to 8.5% year over year, as long as you're investing in good companies. Now, if you're over leveraging, you're playing crap, well, then you figure to lose all your money. But if you place, if you buy apples and, good solid companies that you assume will be in business 20 years from now, those are going to come back, and they're going to suffer, and they're going to come back. And that's where the key part of leveraging yourself and not over leveraging to the market, so that you don't get that fear of panic and putting in money that you can afford, knowing that basically on average it grows 8.5% per year.
So that's an interesting approach, Todd, because some people say stay out, go short, stay in cash, but you're saying stay in the market but hedge yourself with derivatives. That's
Correct.
Your approach.
I mean, there's some great options products out there, but what will happen, David, is what always happens, right? Nobody's doing anything now because they're all complacent, knowing the markets can only go higher. And then when the panic starts, okay, they'll all jump and try to buy puts at the same time, which will overinflate the price of put options, which is the protection to the downside, and they'll overpay for those. So not only will they lose on their equities, they'll lose on their put position as well.
Last question, Todd. And what indicators are you following before you make the decision to, I guess, get rid of all your holdings because a market crash is coming? Are you following the yield curve? Are you following credit swaps? Are you following put-call ratios? What are you looking at?
Actually, it's much simpler than that, David. First of all, I will never dump my core portfolio. I am 100% hedged, and I know my risk to the exact dollar amount right now. Okay, so I will never sell, but I will get short the market based on the price action. I don't need all this information that is out there that everybody else is watching. I can watch price, and that will tell me when it's time to get long or short. And in this case, it would be short. Now, right now, again, as I said, full disclosure, we're long all the equity futures right now. Okay. And, and we're short gold and silver. So at the end of the day, when the price action starts to change, we will start to reverse. And I will stay in a position. I mean, in 2019, we were long the NASDAQ for 48 out of 52 weeks. So again, I can't tell you when. I tell you that the information that you're talking about is not really that valuable, because what you're trying to do is formulate an opinion. And all I'm trying to do is follow the price and follow where the money is taking me. Because I think if you follow the money, you have a much higher success rate.
So are there signals or signs that you would see that would flash a warning signal for you?
It's just price action, David, honestly. I mean, again, I'd like to make it something sexy and fancy. But if you watch the chart, if you use the phases of the market, which is, the market basically trades in 3 basic phases: consolidation, breakout, and blowout. So if you just follow that in the right direction and not get your opinion involved based on what you're hearing in the news or reading in the newspaper, I think you have a much higher chance of success. All
right. So when you do see a signal, a sell signal, let us know. We'll talk about it.
I'll email you right away, baby. Again, they don't always have to be right. They could, we got chopped up in copper. We made a lot of money in copper. We got chopped up for a couple weeks. When they get in tight consolidation, it's painful. But again, once they break and once they trend in either direction, you make money.
Absolutely. Thank you so much for your update today, Todd. I look forward to speaking with you again. And thank you for watching Kitco News. I'm David Lin.